3 o'clock, and let me welcome all of you who have logged in, and especially I'd like to welcome Nina Reinhart and Jeremy Deal. I'm going to say a little bit about both of you in 1 second, but let me first say that we are 65 or so registered, but I know that several of you are taking part in the webinar together with other members of your top management teams. You are sitting in groups. So my sense is that we are between maybe say around 80 people in total, which is good. It's a new record, in fact. And I think it just underscores the interest there is in how can we invest in growth today. How can we really see the future of business, even the realities of COVID-19 and all of that? And obviously that will be central to much of the questions coming. But before saying anything more, let me also reiterate that we will have Chatham House rules so that you can speak freely. There are no press present, and even though I will send a short summary of what is being said, I think you will find that that's rather non-controversial what I'm sending out. So you can feel totally relaxed, all of you, both panelists and participants, that this is a safe place, so to speak. Let me say a little bit about you, Jeremy, first, and then you, Nina. Jeremy, he has his own company, JRP Leadership, and he has a very good background from Honeywell and various high-tech startups. And for the last few years, he is focusing primarily on stocks. And I think that's very interesting that, there is a lot to be said about the stock market in today's COVID-19 reality. So we look forward to hearing from you about this, Jeremy. And Nina Reinhart, she is a startup investor, also with her own company, Reinhart Capital Corporation. And she's particularly interested in climate and environmental friendly investments. And she's working closely with this Swiss-based group SICTEC, which is trying to stimulate entrepreneurial activities. And as many of you know, we at the Lorange Network, we are very friendly with that group. So it's great to have you both on the panel. Thank you, Jeremy, and thank you, Nina. So let me start now, getting right to the questions. And the first one is for you, Jeremy. And when we think about COVID-19 and all of that, and we are still in business and all of that, we're still doing good business and all of that. But what has changed? How do you invest today given COVID-19? Are you able to create value today given COVID-19? I mean, particular focus on what kind of stocks you're picking today, Jeremy.
Yeah, well, thank you for having me on. And I also wanted to thank Guy Spear for introducing us. He's been a mentor of mine. He's an incredible investor, and he's done a lot for me over the years. Zurich in Switzerland is lucky to have him.
Yes.
Have his fund there. So thank you, Guy. So just to go back a little bit, and thank you for that introduction. JDP has been in business as in its current form, which is an open-ended partnership structure, like a hedge fund structure, since 2011. But prior to that, we were making in a different legal structure focused on private investment. So mostly divestitures of public companies, so divisions of public companies or private companies that were distressed or coming out of the financial crisis of 2008 and 9. And we made the transition to investing in public companies because we just felt there was a better risk-reward opportunity in owning a lot of the companies that we were looking at buying, the parent companies of the companies we were looking at buying divisions from. And we also found like there was it was a lot easier to research those companies and to build a more sustainable investment business. So in the early days, with that kind of private equity mindset hat on, I was really using statistical analysis and looking for companies that look cheap based on historical numbers. So balance sheets and income statements that relative to the price, relative to the past, look statistically cheap. And in 2011, when we launched, there had been a lot of pessimism, and there was a market, the market generally believed, the consensus was that we were going into a second double dip, into a second recession. It was one of the most violent years for the market. As for example, the first week we launched in October 2011, the S&P was up almost 10%. And so it had been down significantly before that. So we were going through a period where sort of anything worked. There was a reflation. So we bought a lot. I focused on a lot of smaller companies that I thought maybe were under the radar and looked cheap. And they worked initially, and they but those companies I was forced to sell when they became what I thought was a full value. And that concept of sort of mean reversion of price to value worked in the first year and a half, 2 years. But I noticed as we went along that we were forced to sell with that type of mindset. We were forced to sell higher quality companies that had the ability to reinvest capital. And those companies were generally a little bit bigger and required a different type of looking at the company in a different way. And as time went on, that spread between what we were able to earn versus what I saw return versus the companies that we had sold that went on to earn and grow was just too big to ignore. And so that started me down this road of thinking more like Buffett, which was, Buffett buys companies that he can own for a long time or forever. And he inherited that view from Ben Graham, who said to look at a stock like you're buying the whole business. And if you were buying the whole business, you wouldn't look at it to trade and sell once it hit a certain price. You would make a decision based on the idea that you only had a few times in your life, a few punch cards to make an investment. And that investment would have to just continue to grow. So the outcome would be, the success would be based on business growth and multiple compressing, not growing, but contracting. So the company essentially gets cheaper as you own it because it grows over time. And I really took a hard look at the way the most successful investors in the world invested. And that's one thing they had in common. They made a handful of really big bets on companies that they held for long periods of time. But it wasn't just a long period of time where the return came from. The return came from the ability of the company to grow and continue to defend their competitive position for a very long period of time. And that's where the returns came from. It wasn't through trading in and out of things based on where we think the market is going or some kind of discount to what it could be sold for today if it was sold, et cetera. So today JDP focuses on companies with a 5+ year time horizon that we believe have significant unrecognized potential. And that potential comes from a transition that is either happening in the business or in the bigger sector, or both. And so there's 4 kind of very important pieces to that. We call them companies that fit our strategy are called survivors and thrivers. And so these are companies that can survive and thrive, which is a very small, what I think is, everybody thinks about survivability as a company that will just stay around for a long time. Well, in our portfolio, that's not enough. And then you can look at companies that are thriving potentially, and maybe they're overvalued or whatever the case, but we don't believe that they'll survive a really long time. So we're looking for companies that can both survive and thrive. And there's 4 kind of core attributes of what a survivor and thriver in our view looks like. And I could go into those, but I would say that going back to your question, the coronavirus has opened up an enormous opportunity to look at companies and to invest in companies that are kind of positioned and relevant in tomorrow's economy. And so what it's done is it's brought forward a lot of the transitions that were already happening in the broader economy, technology-wise and other. So it's brought that forward, and in a world where before this recession, people had the luxury of deciding whether they wanted to, for example, maybe they could have advertised, maybe it made sense to advertise on the radio, or it made sense to advertise on social media. But either way, there was an audience. But the trend was obviously going away from something like a radio. And what COVID has done is fast forwarded those trends. And so what was sort of a melting ice cube of yesterday is completely melted. And what was sort of getting traction yesterday has become much more mainstream. So the areas of opportunity are very, very plentiful. So we can go into that later, but we're generally looking for companies in the core portfolio that can survive and thrive. And COVID has just unleashed a variety of opportunities. It's a very opportunity-rich environment.
That's very interesting, Jeremy. Nina, you like to add to that?
Well, I agree on many things that Jeremy mentioned. I mean, I see it in a different seat. I'm doing a lot of early stage and growth investment. So you cannot take more risk than that. And at that point, you start with working with bright people who have a conviction backed by a mega trend, and you don't necessarily even have a business opportunity at that point. So I have a very different starting point, but we do invest in technology companies, B2B, and we do actually, I agree, we invest also in survivors and drivers. And what I mean by that, for me, that would mean young companies that can help traditional industries like real estate or education or travel to really accelerate this process Jeremy was talking about, digitalization, being more efficient, starting to do things that perhaps they never did in the past. Perhaps they never had to do marketing, social marketing, but now they have to. And they're looking desperately for tools and companies and know-how to do this as quickly as possible. So if they're not doing revenues right now as they're supposed to do, they have time and capacity. Even if they cut staff, they have IT capacity to actually onboard these new technologies that will help them to adapt to the situation right now.
Mm-hmm. So it's interesting, if I may add my 5 cents too. It's interesting that both of you see plenty of opportunities given the context of COVID-19, both in terms of more traditional stocks. And I think what you are saying, Jeremy, is that we are back to more value investing, the way we used to think about it. But as we all know, it's been a few years when value investing hasn't done too well, but now it's perhaps back. And you, Nina, you're saying that startups and new ventures, there's plenty of opportunities there too, particularly if we understand how digitalization and more efficient business models can be built into this from the start. And as you said, to have the right people and the right people to help us to pursue that avenue. So thank you both. It's interesting to see that you're coming to the table from two different angles, but you both seem to be optimistic given COVID-19. So let me ask you now, Nina, for to elaborate a little bit on that with a second question. And maybe that has to do with, are there particular geographic areas as well as particular business types that you are particularly interested in? And these might be particularly interesting and attractive now. And you said that technology is part of that. How has the market rewarded technology companies? Is the market actually rewarding technology companies that deal with the digitalization and can demonstrate more efficiency, so to speak? That was a lot of questions in one, and I'm sorry about that.
I like to take the example of the travel industry, which has gone through quite a ride this year. I mean, you have seen the highs and lows have been incredible for them. It's 196 million jobs at risk. It's a very difficult area. Nevertheless, we have, for example, an investment in travel tech, which which is precisely helping the Booking.coms, the Expedias, the Savros of this world to automate a number of things to allow, you know, kind of mass customization of travel bookings, for example, which used to be a manual nightmare.
Yes.
And these companies, despite the fact that they have cut 20-25% of their staff to adjust to the situation, they're actually onboarding. We have tripled the customer base during the lockdown with this startup. So there is an appetite. Of course, the revenues are not following immediately. We know this, but the clients from around the globe have been calling this company to actually, now is the time to adjust. Like Jemery was saying, what was an option in the past is now a necessity. So we have to identify exactly where these urgencies lie. My question to the startup is always, how can you help your client to adapt to this situation as quickly as possible, as efficiently as possible? So we see a lot of interest for this company. Of course, the fundraising process is a little bit bumpy, because if you're not 6 months to profitability, it's a little bit more challenging. But I think we're talking to the investors who know this space, who believe this space will rebound, and they are the ones you have to target. They are the ones who understand and are willing to be for the long run. So travel tech is one area that comes to mind. And perhaps another one, I think education is also an interesting area where you're seeing posts from Canis in Silicon Valley, looking to establish micro schools in the US, so that you have one teacher for 4 to 10 students in a neighborhood. That's kind of an old-fashioned concept that we could not even imagine in the past, and now you have all kinds of creativity coming in education to ensure that the students can continue having education as normal as possible. So I think in all areas, all traditional areas that have been comfortable or sleeping, there will be opportunity, actually.
Mm-hmm. Are there, I mean, it's interesting what you're saying also, Nina, in the sense, with both your examples, that we have some traditional players that are struggling very hard to adapt. I used to be on the board of Royal Caribbean Cruise Lines, and their value has dropped from 100 to 20 since the crisis began, and they are still struggling to find a new model, And as some of you may know, I used to be the head of IMD in Lausanne, and they are having a very hard time because of, even though they are having virtual teaching also, they're still relying on filling up the classrooms. So some of these traditional players seem to be struggling to find their new ways. That was just jumping in, perhaps wrong here. I should have asked you, Jeremy, to jump in first.
No. Yeah, that's true. There's kind of something for everyone out there. Bulls, bears, and everything in between. That's what recessions do. So there's a podcast that I recently listened, that I absolutely recommend, and Nina, you probably know, it's called Invest Like the Best with Patrick O'Shaughnessy. And one of the guests that he had on recently was Eric Vishraya. I'm sure I'm brutalizing his name, and from I believe Benchmark Capital. And the episode was called like the past, present, and future of SaaS. And so while the title and maybe a lot of it doesn't directly correlate to exactly what we're talking about here, there's an area that one of the segment of the podcast that I really identified with. He talked about Mad Men to Moneyball, and this concept that, and this is also an area that he talked about advertising, and it's an area that we're, as a fund at JDP, we're heavily invested in, kind of the future of ad tech and advertising in general. So he talks about this analogy of Mad Men to Moneyball. And what he says is, in the old days, and not that long ago, advertising were a bunch of madmen, like the show, sitting around drinking scotch during the day and becoming very, thinking and becoming very creative, and and whatever they said went. And then somebody looked up with the with Google and figured out after they figured out search, they figured out, well, we can figure out a lot more than just search. And when the digitalization of advertising was introduced, people figured out that they could measure and account for the ROI and put an ROI on the dollars or the money that they were spending. So it's an industry that rapidly evolved from Mad Men to Moneyball, and Moneyball refers to the Michael Lewis book that talked about the story of the Oakland A's, I believe, where this coach took a seemingly mismatched group of players and put them together based on deep statistics and analysis, and put together a team instead of just intuition and gut, and went on to win. And I think that's what you're seeing across a lot of industries, as they point out in the podcast, and we're obviously seeing it as well in the companies we're invested in advertising. But you're seeing this transition from Mad Men to Moneyball. So a lot of businesses that, you just had an old guard sitting at the top are now being disrupted. And so many business models people thought were durable are no longer durable, because they're being turned upside down by new measurability and returns on and the returns that comes with as a result of technology. And so when it comes to, for example, advertising, the returns you can get and the measurability that you can get through advertising through streaming television, for example, can be up to 5 times higher than the advertising that you would get through a traditional show, a paid television show. So these are win-win-win for the consumer. So it ends up for the consumer and the advertiser, I should say. And the person that loses is the person in the middle that once was the Mad Men of the group loses and the Moneyball group wins. So as an investor, you have the opportunity to choose which side you want to be on. You can kind of gravitate to what looks like the cheaper company that's still on the Mad Men side and just hope that they can kind of figure it out. Or you can choose to kind of move over to the Moneyball side where they have figured it out. So to take it back, to advertising, you can now, what used to be, 20 to 30 minutes sometimes, maybe 20 minutes per hour of television and advertising. An advertisement would go on and on and on and on, just the same thing, and it really wasn't that measurable, and it was just was not a pleasurable experience to watch, traditional cable television. Now through streaming, you may get served up an ad if you have ad-supported television. So not the Netflix, but let's say a Roku device, for example, or an Android TV device, for example. You can watch the same television shows and maybe get served a fraction of the ad load, so half or less of the ad load. And the return that the advertiser sees is much higher. And the advertisement the consumer sees is much more relevant to what you might be interested in, because they have the ability now to track and measure that all the way through the buying experience. And so that's an example where just kind of everybody wins. But that by nature is very deflationary, because what you're doing is you're cutting out costs. And I think that's something that's not necessarily talked about enough, the deflationary impact of technology. But so that's the side we want to be on. We want to be on the Moneyball side, the side where everybody wins, and you pick the industry, and it's happening.
I would add to that yes, cutting middlemen, cutting costs, but you must invent new value as you innovate. That's super important. You cannot just bluntly digitalize or cut middlemen. You have to come up with new value for the client, for the consumers. And I think that's an effort of creativity and non-linear thinking that those are the right people we're looking for to really reinvent industries when they're too ripe and they're too crowded, like ad tech. I mean, advertising is a great example.
Yeah. It's interesting that from what both of you are saying here, we have been doing some research which adds to this also, very much consistent with what you are saying. And we are seeing that companies that started out as, should we say, madmen, kind of traditional companies, they seem to have a much harder time to find this new value proposition, versus companies that started out digitally and didn't have the, should we say, the weight around their neck of the old technology. And I don't know whether that's true or not, but it's, at least that seems to be what we are finding, that these winners now typically seem to be rather free from old traditions. They are able to start with blank pages, so to speak. Maybe that's not true, but it seems to be something in that. Let me ask now you, if you can comment on the next comment here, next question here, Jeremy. Clearly we have seen a growth focus, and we have seen a liquidity focus. Growth typically more long-term, liquidity typically shorter term. You touched on this a little bit already, that you're really interested in companies that are, should we say, able to kind of rich enough and strong enough to grow, versus the day-to-day trading is perhaps more based on short-term liquidity positions. But maybe you could say a little bit more about this dilemma, growth versus cash flow versus liquidity.
There's a lot of ways to think about it. It's definitely something. I mean, I actually still don't consider myself a pure technology investor. We've never made an investment in a company with no revenues. We've never made an investment, for example, in a biotech company or just a pure, just a team of people that plan to start something. So I think there's the first thing you have to look at, and when you look at a business, you need to say, what inning are we in? Are we in the first inning? Are we in the last inning? So as you get closer to the end as a business becomes more and more mature, it becomes much easier to pick up the 10K and look at the traditional GAAP accounting matrix and look at it more like a bond and see what it is. It's easy to look at companies that are very, very far along in their process. And for some companies, if you can, for those companies that are really mature, if you can grasp with a competitive advantage and you really believe that they'll be able to continue to raise prices, and at least stabilize, at least retain their advantages, and they have a good capital allocator on top. So that capital allocator, whether it's Warren Buffett or whether that's, I don't know, a John Malone or something like that, who has this gift of being able to manage buying back stock or giving back cash or something like that, that's not a bad way to invest. But the risk shifts to the capital allocation on top, and it actually, the longer you go, it actually even shifts further than that, because you get into a situation where they can't necessarily, you're basically betting on one or two people's ability to be able to take cash and do something with it. But the problem is a public company investor who's like myself, who's benchmarked against the S&P 500. We look at that as the S&P 500 as the 500 of the largest companies in the world, the best companies in the world, and therefore is my risk-free rate of return. Because if I can't beat the S&P 500 going long with no leverage over a long period of time, or even a reasonable period of time, 10 plus years, then you're probably better off just owning the S&P 500. So I'm not a private equity fund that gets paid based on the internal rate of return or the IRR, the cash that I distribute back to investors. I'm not a venture capital fund who can mark to market. And so because I'm benchmarked on total return, what is most important to me is a business's ability to reinvest their cash flow at an incrementally higher rate of return than they did the year before and the month before, the quarter before, and the year before. That's really what we're looking for. So what that means is, there is scale enough in the business to where that incremental gross margin dollar that's reinvested has an exponentially higher rate of return, so a non-linear return, than it was a year ago or 5 years ago. And that's where the compounding starts. So that's how you get compounding. So I'm not as interested, when I'm looking at a company 5 and 10 years out, I'm not necessarily as interested on what the numbers look like maybe 5 years before, because when you're investing, you lay out, like Buffett says, you lay out a dollar or a franc or a euro and expect to get something back in 5 or 10 years. You invest based on the future, not the past. And so you have to get a strong sense of what the future is going to look like. And when you look at companies that can compete against my competition, which is essentially the top 50 companies in the S&P 500, which determines the returns of the S&P 500 going back since its initiation, I have to make sure that with the incremental returns on invested capital, the companies I own are at least at, if not better than, my competition, just like any other business. And we're at a point where the best companies in the world are achieving enormous returns on reinvested capital. And there's a point where it becomes extremely dangerous to try to bet that one man or woman sitting at the top of an old, established, mature business can take cash and reinvest and find new things in a zero interest rate environment, other mature businesses, at a higher rate of return than you can get owning the very best companies or the S&P 500. So to make this a long-winded answer, but the bar to compete against the S&P 500 is high, and it's high because if you can't beat it, then you probably should just own the S&P. So you need to be able to look at that competitive factor and say, what is driving my competition, and what is the opportunity that my competition has for incrementally invested money, and versus can I find something equal or better than that, and then concentrate on those businesses for a period of time that seems reasonable or that you can get comfortable with. So I can't give you an exact formula other than what I'm looking for in those companies when I take a 5 or 5+ year view, is how the business is going to look from a gross margin perspective and from an operating earnings margin perspective and free cash flow perspective 5-10 years out. And the last thing I'll leave you with is, before we did this, I looked up just very, very high level, if looking back 5 years ago, what the valuation of some of the these top companies that I'm competing with, because I'm competing against the S&P 500 as my benchmark, what were their valuations 5 years ago relative to what they're earning in operating earnings today? And whether it's Apple, Amazon, Microsoft, they all traded for between 5 and 8 times equity value to operating earnings just 5 years ago. So single-digit multiples of operating earnings 5 years ago. And to me, that's what value investing is trying to identify the present value of future operating earnings. Now, could you have determined that those were deep value investments, essentially, because 5-6 times operating earnings, excluding all the cash and rockstar balance sheets, is a very distressed kind of multiple that you would expect to see in a company just emerging out of bankruptcy, for example. So could you have determined that based on looking at the prior 5 years? No, you would have had to take a 5-year view or 6-year view, and you wouldn't have gotten it perfect. But I think that the answer would not have lied in just screening for the past based on past returns.
What do you think about this, Nina? I mean, you're also thinking about where are these high-tech startups going to be 5 years from now? What's your secrets here?
Well, I think first of all, I put most of my effort and energy into illiquid investments, as you know. So I have, of course, liquid and illiquid. But when it comes to the illiquid private markets, I mean, I will try to pay more attention to companies, as I said, closer to break even or are slightly profitable profitable. And I think today I may be able to negotiate better valuations. So that's just one side. But the other side, the liquidity or public markets, I think technology companies, those that kind of are building the infrastructure in order to make the mega trends possible. So the hardware companies, the software companies, cloud computing, the new material companies, I think those are needed if we want to continue building on the mega trends, you know, the 3D printers, the AI, the big data, the blockchain, bioinformatics, and so on. So I think we should, I try to think about, you know, what are the building blocks from the stock market companies that we need to make these mega trends possible so that they're really adopted and used in 5 or 10 years from now. And that's where I start the thinking process in terms of, can a tech company, well, because I'm looking at tech mostly, really support the economy of tomorrow.
So what you're saying, Nina, is that it may be difficult to actually do research in such a way that you can actually quantify the cash flows and what you expect. But perhaps it's more viable and easier to understand what are some of the technology-based building blocks that seem to be part of, should we say, a healthy cocktail for the future.
Absolutely. I think it has less to do with analyzing spreadsheets and numbers, you're right, but also having some convictions and revisiting these convictions regularly to think what are the key technologies that are actually going to be the winners or are going to be able to establish themselves as a standard in a new industry. I think that is a mixture of research, of being in the market, understanding you know, how clients are adopting these technologies and so on. So it's not perhaps as analytical like Jeremy would work with a lot of public information and spreadsheets, but you also have to combine a little bit your sense of the market, your own intuition there.
Yeah, and you probably want to comment on this also, Jeremy, and maybe I could just add in my 5 cents there. It's got to be a very big challenge for you to actually do the research to do what you said here.
Yeah, it is hard, and I completely agree with Nina that there is a point where qualitative becomes more important. You need to be able to gauge the owners or the management, the culture of the business, because things are constantly changing. And so you might have the right management for what's happening today, but can they adapt and change? So back to the survivor and thriver, you know, the first thing I mentioned was the first thing on what we notice of companies that can survive and thrive for very long periods of time and outperform the market are businesses that have a model that is adaptable and relevant to tomorrow's economy. And the fourth thing is an alignment of interest between management and owners. And the alignment of interest, yes, the obvious is that they own a big chunk of the business. A lot of them are founders, et cetera. But they have an alignment to see through the changes. They have an incentive to be given a leash, to be able to make mistakes, to be able to not make decisions based on the short term, but based on the long term. And the most famous person that's done that is Jeff Bezos. You know, now looking back, we think, you know, he looks like a genius, but it wasn't just a few years ago that many people in the investment community just said, oh, it's a losing company. It'll never make any money. Look at, he's such an idiot. He's giving away free shipping. And so that ability to be able to say, no, we are going to make this long-term investment and we're going to take this risk. And so the shift becomes looking more at what is the bigger opportunity and what is the, you know, the blow by blow, the day by day, the week by week evolution of the business. And so sitting back, the days I think of sitting back, and I don't know if this was ever true, but sitting back and just doing essentially nothing and waiting until the next quarterly earnings came out and then reestablishing a model and a view on that company, those days are long past us. We as small fund managers, there's so much we can do every single day to continue to learn and explore. And, you know, like Gavin Baker said in an interview that he did with Pat O'Shaughnessy on Invest Like the Best, he said his goal is to be in the 1% of knowledge of shareholders, of of passive shareholders of that company. His goal is to be in the 1%. And you definitely don't do that by just waiting for the quarterly announcements to come through. There's industry events you can go to. There's transcripts you can read. There's so much information. There's podcasts out there. There's just endless people you can talk to and holes you can dive down deeper and deeper to get a sense for what's happening, either whether it's with the competition or with other employees or just, from any angle you want. And you're absolutely right. It's a full-time job. I mean, and at JDP, we have about 5 stocks that represent almost 90% of the portfolio. So we're very concentrated. But these are companies that we have worked on a really long time and feel confident about, and we spend most of our time on. So if you looked at a small private equity fund, I think you would think it was strange to have 20 positions. So we look at it around the 5 or 6 portfolio. We actually have more than that, but 5 core, maybe 4 to 5 core holdings. The balance, those are ones we're working on that don't necessarily, that haven't gotten there yet. But if you think about, how much work you can do on any company, it's just, there's never enough. There's always more you can do. And that doesn't necessarily mean that it becomes a safer investment because you work on it more. It just means that you don't have, it's not realistic to think you have the bandwidth as an investor to own 20 or 30 companies. By the time you start owning 20 or 30 companies, you're in a very, very different business of more of a stock market kind of, trading type of investment strategy around volatility and all that. You're not a total return, long-term oriented investor. So based on what we do, you're absolutely right. It's a lot of work, and I think, one of the ways we simplify our life is just by focusing on a handful of businesses and not worrying about the rest of them, the rest of the 6,500 public companies that we don't own in the US.
It's very true that strategy means choice, but it's very difficult. That's the dilemma. Now I have a question for you, Nina, and you already touched on it, namely those building blocks, technology-based, etc. And you already, both of you touched on the fact that in the end, there's a qualitative judgment here. You know something about the technologies and you have to add your own judgment. And maybe you could say a little bit more about what you see as particularly important. And maybe also, Nina, you could say a little bit about which geographies seem to be important here. I mean, traditionally we have had, Silicon Valley. We now have, of course, ETH in Zurich. We see all the time over the last few months how our Chinese friends are coming up. It's not easy to quite understand where those building blocks reside.
Yes, you're absolutely right. I think I invest relatively early, so the proximity and the frequency of contact is extremely important. And that's one of the reasons why I self-limit myself geographically. Well, especially now it's not really possible, but you could go around and fly around the world in normal times and try to discover each region, what are their strengths. But to be very honest, I have simplified my life by also trying to just exploit the riches we have in Switzerland and in Europe, because we do have, very strong competencies. You mentioned ETH, VFL, they're well known around the world. We have a lot of talent. We have a lot of, that's the reason why Google also came to Zurich. I mean, they're absorbing, X% of the graduates every year of ETH. So we have strengths, AI, big data. We have people working on this. We have also a whole ecosystem around VO with really everything around pharma and biotech. So we have strengths. So I'm trying to exploit those strengths that we have locally, because there's a lot of work to be done to get, as I said, from the concept or the research out of the lab into a business opportunity that can actually be defendable globally. There's a lot of work, and that's the work I concentrate on. so I do the due diligence, I don't outsource that. I think that's a core competence. That's where you understand the pulse of the market as well. And yeah, you have to have a conviction, as I said, and then try to support these entrepreneurs to fully exploit that. So I give you an example. We're talking with an AI company, bright people, very enthusiastic, and they're trying to make the life of AI engineers in corporations easier. That's how the conversation starts. And I tell them, well, I'm not sure the CEO of your client CEO will sign a check with this sentence. You must make a difference on the bottom line. And that's what Corona also does to us. The bottom line is increasing your sales significantly, is maintaining or increasing your margin significantly, is reducing dramatically the risk of your firm. Those are the things, this is the language that entrepreneurs need to speak and demonstrate when they talk to their clients. So a lot of my time and work goes into doing that. And by doing that, I also understand how the future of this industry is being built, which technologies I believe will survive and thrive, to use Jeremy's words. Right. So to make a long story short, I think I'm rather local. And I may go to other geographies in Europe when there is a real need and I discover particular companies or niches of intelligence that I think are worth to discover and work with.
And just to add to that, Peter, if I could, just to add to that, I moved to Europe over 3 years ago, and I have been shocked at the level of talent that I have met here, both in private startups, technology, and in public companies. And it definitely doesn't get the recognition that it deserves. I come from California, and it used to be, before I moved at least, it felt like the center of the tech talent universe, but that's rapidly changing. It's one of the things that's happening after, one of probably the benefits of COVID is people are, I think, moving to where they feel most comfortable, and it's opening the horizons of people looking outside of those traditional areas. And I've been so impressed with the talent that I've found. I've actually invested privately in a machine learning fintech company based in Amsterdam, and they have a small team kind of all over the world, from Vienna to Austin. And Zurich is also an incredible talent and pool of talented people. Every time I'm in that city, I meet such incredible, gifted, not only entrepreneurs, but just coders and thinkers, very gifted people. And I think that's probably a very rich opportunity set to look for tomorrow's companies, if I had to guess.
I think that's very valid, what you're saying there. I used to be a professor at MIT, and I must say that I'm not missing that. It's fine to be based here in Zurich. Sorry, that was just a little mal-apropos comment. But let me ask you now, if I may, Jeremy, one final question. What do you see as factors that, given this coronavirus reality, what's increasing the uncertainty due to this? I mean, both of you have been very good at stressing that there are great opportunities and in many ways to decrease uncertainty, in fact. But maybe there are certain uncertainties that
Yes.
Please
elaborate. Yeah, absolutely. There's a lot of, so a lot of the uncertainties are probably at least around the competition that's bubbling up as a result of the recession. So recession is where a lot of the great opportunities come from. The great businesses are started during recessions, and during times of certainty, it's that people don't necessarily, feel the same fire and heat that they do to go out and innovate and disrupt. So I think for a lot of companies, they don't necessarily know or see the next, two guys in a garage in Mountain View starting the next Google, or two girls in an apartment in Zurich coming up with the next algorithm that's going to change the way we either travel or the way we eat or the way we do something important.
Yeah.
So I feel like some of the biggest threats are to existing larger and medium-sized businesses is you have to be very, very close to what's happening disruption-wise, because there's a lot of competition just in everything coming down the pipe. And so you need to pay more attention than ever. You know, people are not willing to sit around unemployed and do nothing forever. They just can't. And so top talent will go where they can get paid for it, and really stretched environments like this. There's a lot of new ideas, there's a lot of opportunities, and that we don't recognize until afterwards. And then obviously there's the typical macro stuff, zero negative interest rate environment and the elections and all that. But I think it's just much less interesting for me to think about those things. Interest rates are important and whatnot, of course, and maybe policy and I worry about a lot of things. I worry about growth in general, but at the same time, global macro growth is obviously going to be challenged on paper for a long time. I worry about the way we calculate inflation versus maybe underlying actual inflation. I worry about the way I worry about leverage loans. I worry about all those things, and I think about all those things. But at the end of the day, as I said earlier, being a public company investor allows you the flexibility and the luxury of trying to steer clear of the most unknowns. And just to reiterate, I think the competition, though, that's coming down the pike for about everything is probably going to start bubbling up in a vigorous way.
Yeah. What's your view on what's becoming more risky, Nina, given more uncertainty and risk given the coronavirus reality?
Of course, we can start from the beginning, having second wave, third wave of this epidemic and having more quarantine. I mean, that's certainly immediate risk. Not having the funds to develop this vaccine, the vaccine being late. I mean, Bill Gates was saying in 2021 we should have one. Let's see. So I think this could add a lot of nervousness, unrest, and I really hope that governments are able to, different governments are able to learn from this situation and instill a little bit of measures that will bring some more confidence in them and less fear, because fear is quite an ugly thing, and few can benefit from fear, but I think fear can lead to social unrest and things that are very difficult for us to comment and control. So I would hope that we can learn from this situation, and businesses and government can really find new ways and communicate properly in these new ways so that everybody can stay in business, because that's essential for the stability and the confidence of people and institutions.
Mm-hmm. Now we have only 7 minutes left for you, Per, to ask questions from the audience. But let me just say that normally we close down the part of the audience so that only members can continue. But now today we will keep it open for all because it's so interesting, and it's always interesting, but it doesn't make sense to close it down for 7 minutes either. So Per, you go ahead now, and let me just say to the audience that any questions that you have come in, that you have raised that we won't have a chance to discuss, will be discussed and commented on separately on a one-to-one basis later. Go ahead, Per.
Yeah, just to follow up on that, if you have any questions, just pop them in the Q&A button at the bottom there. So and we'll address them in due course. So the first question is for Jeremy here. And you are, of course, comparing publicly listed companies and unlisted companies in your work. And you have made the argument that in your opinion, the most future-proof companies, and not only the most future-proof, but also the most attractive on valuation terms, are the publicly listed companies. And how do you sort of broach that or compare that relative to like stock market valuations that are now at all-time highs in general, and there's quite a bit of quantitative easing? So how do you say that they are also the most attractive on valuation terms?
Well, I wouldn't say so. I think that comment got a little bit misunderstood, and I wouldn't say that is necessarily always the case. So I'd like to break that down into two pieces. So just looking at traditional private equity, so established businesses or kind of traditional businesses that are leveraged buyouts versus those peers in the public market. There's an enormous disconnect, and there has been an enormous disconnect for a long time. You can't go out and buy. If you look at the big leverage buyouts that are happening, or even in the middle market that are leverage buyouts, or even real estate valuations relative to their publicly traded peers, there is absolutely a spread. So you take any publicly traded mall, for example, and pick through the rubble and find a very high quality one. And I'm not going to name any because it's almost irrelevant. But you name any in the top 25% quartile, there's no way on a cap rate basis they would compete with with pulling out one or two of those assets and buying them privately. For example, you can't compare that to what you'd have to pay to control a AAA or an amazing property in the middle of, for example, downtown Zurich. You may have a 2-3 cap rate or less, but if that's part of a large REIT or something, that there's going to be a valuation discount. And the same goes for traditional businesses. When it comes to tech companies, again, I'm not a pure tech investor, but my observation has been that companies, the highest quality venture-backed companies are becoming much, much bigger before they go public, and they're actually going public without not doing a traditional IPO process. So, for example, Spotify was one of the famous ones to start this, where they did they just offer the stock out instead of it being underwritten by a bank. And then Adyen here in Amsterdam did the same, and now Palantir is doing it, and several other high quality companies are doing that. And you could argue that companies like Stripe, they're at 30+ billion valuation and they're private. I mean, those are some of the highest quality companies, that, at least from the information we have, they're some of the highest quality companies in the world. And I'm not sure that they would be necessarily cheaper if they were traded publicly because they're such high quality. But the further down the quality list you go, the bigger the spread gets between public and private. And absolutely, there's no question in my mind that traditional private equity, traditional businesses, whether you're buying a $10 million private buyout, leverage buyout with something with 5 million in EBITDA or whatever it is, the valuation is going to be higher in a rationally negotiated private transaction than it is in the public markets, especially today. Now, look, most of the S&P, most traditional companies are down significantly and have underperformed the S&P year to date. I mean, many companies are down 20, 30, 40, 50, 80% in the last year. So comparing those companies against ones that would be, if it was bought out in a transaction by a private equity fund, that could then switch from being paid on total return, but being paid on IRR, on levered IRR, is a very different way to be paid. So you could make the argument that if John Malone were to go and make an offer for Discovery, there's no way he would pay anywhere remotely close to what it's trading now for, because he would benefit from being able to redistribute the cash to shareholders. So it just depends on what segment of the market you're looking at for that public-private spread, at least in my view.
Good answer. Good point. Nina, you're an active early stage investor. You could say venture investor, angel investor, and basically, what are you seeing in terms of changes in terms of pricing terms, structures, due diligence process, and basically a little bit of the mechanics of the deals you're looking at? Have the multiples gone down, and could you give some examples of where we are nowadays in Swiss startups in the Swiss startup scene?
Well, one thing I can say is that the investment processes and due diligence are going on. There are even investments being made when people, you know, the investor and the producers have not even met in person. So that's happening, which is great. It's unusual, but it's good. I think there is, of course, some companies have to revisit their valuations. Depends on the alternatives they have. The banks here, the CKB, for example, have been quite aggressive with their taking advantage of this situation and proposing either loans or investments. So I think there is activity, and depending on the how can I say this, how essential you are as a startup, whether you are in a nice to have business or in a must have business, it's all about competition. So if you have enough investors, you can dictate much easier the valuation, of course. If you are in a cash crunch, a lot of companies unfortunately are sound. They're not necessarily profitable yet, of course, but they're sound, and they were just caught in the middle of fundraising process when Corona started. That's just bad luck. Yeah. So there you can, of course, try to get better valuations and down 20-25% to when they would have been in February or in January.
Yeah.
So I think it really, I've seen very different cases. I can't just say that there's a general trend, because it depends very much on which sector you are and who have been your investors so far. Can they follow or can they not?
Exactly, the strength of your investors. And
it's difficult to generalize, I would say. I've seen a lot of very different cases, actually.
I see your point.
Sorry, I have to break in here. We are running up against the clock, and we have to stop at 4 o'clock, and it's already 3 minutes past 4. So let me thank both the panelists. Dina, thank you very much.
Thank you for having me.
Yes, thank you so much for having me.
Thank you. And Per, let me
fun.
you too. And we will follow up with additional questions on a one-to-one basis.
Please, happy to answer any questions.
Yeah. Okay, thank you all, and goodbye.
Thank you.
Wonderful afternoon. Thank you.
Thank you.